point in time to a certain degree. So I think that's a lot of deals. So switch gears on me a little bit here, and let's talk about my favorite part, which is business lending.
Yeah.
Yeah, right? So business lending is a whole different area, and it's a whole different animal, right? And so if you start a business, there's multiple ways for you to get lending. And the one that I think people don't understand is SBA lending. It's a very difficult one, right? I think there's a lot of hoops to jump through, a lot more, and you end up with 2 loans. And then there's also the regular conventional C&I lending, real estate lending, stuff like that. So let's break some of that down a little bit. So let's talk with the SBA. So if I'm a new business owner, been in business, how long do I need to be in business? If I started a business to even get a mortgage, how long do I have to be in business to get a loan? This goes back to Tom Kuchar's with Texas Tech Federal Credit Union's conversation.
As far as being business, I think they, and of course you're talking about a mortgage, and they
But typically you got to be in business 2 years.
2 years, yeah. That's what they like to see. Have a 2-year history of that. So yeah, that becomes a challenge with people that own their own business, and they're still, they walk in, they start a business, and they're wanting to buy a house or whatnot. Well, they may not qualify at that time just because of the rules that are associated with a mortgage. And so,
but isn't that on commercial lending too? I got a guy in here he's knocking down $400,000 a month in net earnings, but he's only been open 9 months.
Yeah,
and nobody will touch him.
Well, history does mean something.
It does,
and I don't know what that amount of history is on a
it goes back to a
commercial loan.
Relationship, though, right?
Well, for sure, if you know the person and you understand their business and you see the potential there and you believe in them, I mean that to me is something that you may be willing to go bat for them, whether it's 2 years, 18 months, or a year. If they've had extreme success and you see that they're going to continue that same success, or the likelihood is there, well, then you may hook your wagon to them. But at that point in time, that's when SBA comes in, because SBA kind of, I guess it
what's SBA stand for?
Small Business Association. And so what that does is they come in and they got several different programs that small businesses can qualify for, and what it does is it minimizes the risk to the bank. And so the way I would explain that is, let's just say that you came in, you started a business, and you needed to get a new computer system and some equipment and stuff like that within your business. $50,000. Been in business 6 months. I show good profits each month. This, that, and the other. I've got a little bit of liquidity and capital in my business, but I don't want to use all of it because I'm still growing. Those kind of things. Well, through the SBA programs, some of them are where you'll put a 10% on whatever that loan is, and then we'll loan the difference, and we get a guarantee from SBA to where if you defaulted and we had a loss at the end, they would pay back a portion of that back to the bank, and so that's the way that would work, depending on what the percentage of the guarantee is.
You said something that's really important there. So on a commercial loan, what is the typical community small business lending requirements for small business owners to put down? Isn't it 20%?
Well, and it depends on
the program and what you're trying to do,
sure,
right?
Sure, but yeah, a bank typically on equipment and things, real estate purchases, things like that, 20% is kind of where a bank starts at. Now you've got some more aggressive lenders that may do 15, or some that have done 10, but 20 is where it starts. I've even seen some have a kind of a standard of 25%, and what it is we just want the person that we're loaning the money to have some skin in the game. I mean, that's all there is, because they're part of that relationship too, and so that's part of the deal on that. So,
but it was a good point with the SBA because of the small business aspect of it. They're going to allow you to do only 10% down instead of 20 in some cases, in many cases. Mm-hmm. So your capital up front that you have to put down into the business, because you are a small business getting started, you can put less capital in order to actually grow your business. So sometimes an SBA loan makes sense.
So SBA is just they're the government put them in business to make it to where a bank would make it more advantageous for a bank to want to make a loan because they're protected from that aspect as long as whatever they've taken for collateral on that business loan as well. So yeah, the SBA's got many good programs. Percentages down, it just is going to vary based on what the request is, but typically with SBA, your down money requirement, down payment on whatever you're trying to purchase is less
than a conventional.
And then the
commercial
bank sees less risk there with SBA being kind of partnering.
So let's put this all together, right? So you're talking about, let's hypothetically say that it's a small business. My watch just went off. I apologize, but hey, breaking news here. So we'll get off that. But 10% is going to actually go to the lender. Excuse me. The lendee, right? The business is going to pay 10% down. The SBA is going to cover 40% of it, and then you're going to back up the difference of 50%. So for the bank standpoint, y'all's risk in an SBA loan is only 50% to the asset value of what they're lending to.
Now that scenario you're talking about is typically on real estate loans. So if you're purchasing real estate, they've got some programs out there. There's a 504 program, and then so that's what you've basically described there. So yeah, so initially let's just use you for example. Let's say that you came to me and wanted to borrow money to purchase a building, and you're kind of new. You've been in the business a while, but now you're ready to get on your own. You're wanting to start kind of your own deal, but same kind of business. So you're not really recreating the wheel with something. You're still doing the same thing you've been doing, but you're just maybe becoming independent or breaking off or doing something like that. And so let's just say that it's $1 million to purchase this building, and you've got some money set aside. You're financially strong. You show to have good earnings, those kind of things. And so what we would look at on that, since there is a little bit of a not concern, but just you're still young and growing and those kind of things. We may say, hey, let's go this other route and let's use SBA to kind of assist us on this, because you say, hey, I got this much cash, but I don't want to use all of it. I'm willing to put in, how much are y'all going to require, basically? And we say, well, if we can utilize this program that minimizes the risk to the bank, we could probably do that. And I think they require 10 or 15% down, where a standard bank may require 20 or 25% down. Everybody's different. And then, yeah, that's what we do. You fund it, and then SBA comes in and they take out a portion of that. It's typically, I think it's up to them, but typically it's like 40% of that. So you've put in, say, 10%. They take out 40 of it and they set it up. It's still a loan through them that you still have to pay back, but it's not with the bank. And then the bank has a 50% loan in that same scenario that we're talking about. And with that 50%, the bank has first lien position too, and so that's the other advantageous.
So I want to talk about first lien position, because I think that a lot of people don't understand that, but let's also talk about the difference inside the structure. So inside the structure, you put 10% down, 40% hypothetically goes to the SBA, and then the other 50% goes to the commercial bank that's backing it. So there's actually two loans, and I think a lot of people don't understand there's two loans wrapped into one loan package, and that the SBA loan in many cases can be stretched out longer as far as an amortization schedule than what an actual community bank loan typically does.
Also, the rates are fixed for a longer period of time on the SBA portion, which is more of a fixed cost for the customer.
Yeah.
The bank's going to probably fluctuate their rates over 3 to 5 years. It may reprice during that time.
And explain what that means, right? So repricing, let's say I have a 20-year commercial loan with you. You're repricing what the rates are every 3 to 5 years.
It's based on how it was set up and how the term was set up. But yeah.
So how do you reprice those rates? What do you use to reprice those rates?
Well, typically you're going to use an index like Wall Street Journal Prime up front whenever you negotiate the deal and set up the terms. So it may be Prime plus 1, and at the time we close the deal, say that's 6%. I mean, I'm just throwing out some numbers.
Right, but I'm giving an illustration for people to go and see. So they can Google Wall Street Prime, and they can see what the current rates are today.
Yeah. And that's what Prime is short-term rates, and that's what the Fed's been moving here lately is all of your short-term rates, and you hear about increases and hikes and those kind of things. But so anyway, let's go back to the scenario. Say we make the loan, it's at 6% because it's prime plus 1, prime's at 5, so one over that would be 6, and we may fix that for 3 years. And at 3 years, if it reprices, it's going to go back at that point in time at the market and see what that index sets at what's prime setting at that time, and it's still going to be the same prime plus 1 for the next 3 years. Or if it was,
but the Fed rate or the prime rate could be lower or
fluctuate.
high.
Correct.
Why do y'all do that?
Well,
Because it's the cost of the lending from the Fed, right?
Well, not only that, but also we're repricing deposits all the time too. Most people come in and do a 1-year CD. Well, after 1 year, we don't really know what the rate's going to be, so our margin could go up and down too. And so we're constantly repricing deposits within the bank, whether they're going up or down. And then and that's what we're basically loaning out. And that's all based on how all the markets are working. But then prime's going to kind of follow that too, as far as that goes. And so we're just trying to stay consistent with the way that we
What the
agree
current market is.
with that, and then what we've agreed to do with the customer.
And I think that's a very important point, right? Because that could go both ways.
Mm-hmm.
So if interest rates are going up and you're in 3 years and you're getting repriced, you're going to get a higher rate on your interest rates that you're paying into that current existing loan.
Correct.
But it also goes the other way. And I beat you up a couple years ago. And I was like, no. Prime's way down,
Yeah.
right? So we're going to reprice this and go lower. And you did that for me.
Yeah.
And I think that also attests to the character of the bank that you're working with and also you as a bank lender, is that you did reprice that lower for us, right?
Well,
And
it was the anniversary of the
Three-
whatever we were setting at. I can't remember. But
if it was 3 years or 5 years, I can't remember. But that's typically what the scale is. It's every 3 or 5 years, right? That's the rhythm that banks reprice
Correct.
their amortization schedule, and that's what that's called, is an amortization schedule, right? It might be 20 years, but you're repricing that loan every 3 to 5 years as you're going through that 20-year cycle.
yes, that is correct.
Yeah, and that's really neat to illustrate and to actually have a great conversation with people, because I do not believe a lot of people understand that. And so here's how it could go bad. So if you're sitting down and you're financing $1 million building and you're looking at it and it was 2010 or 2014 or whatever, the interest rates are at 2%, right? And you're pricing that loan at 4.25 on prime, right? And then all of a sudden we're in 2023.
Yeah.
And now it's at 7 or 8 or 9, you could get a stark difference in your monthly payments,
Oh yeah, for sure.
right? And so I think consumers need to understand that interest rates matter. Debt matters.
Yeah.
And so as you're actually going through these loans, when you're talking to your banker, I think it's great to keep that relationship with your banker, even though it's a loan that you're taking for 20 years, and you might have it not need a conversation with you. Like, I'm fortunate that I'm in the industry that me and you talk on a personal level, but also on a professional level,
Sure.
pretty regularly, right? But most, I would say, how often do your guys have a conversation with you? Once a year, maybe?
No, it just depends on the business and what their needs are. I mean, you'll have some that will, talk to you on a monthly basis, based on what their needs are, and you'll have some that, you do talk to once a year. It's probably kind of similar to your business in some aspects with some of your clients. I mean, there's some that probably need you more. And there's some that say, hey, I'm just going to let it ride for a year, and we'll have our annual or our quarterly meeting or semi-annual meeting. It's the same kind of deal, but I don't necessarily set those up with my customers. But we always go out and check on them, from time to
of
time,
course.
or place a phone call or do those things. Just, it goes back to that relationship that we were talking about. And
That's just because you're a good loan officer.